All right, guys, Ben Graham, again, your local trusted real estate advisor, your investment advisor when it comes to buying rental real estate, income producing properties. And today I'm presenting an exciting addition to this series that we're doing on rental properties. And this is the Excel analysis, the numbers, the math, the crunching, all that good stuff. So let's get right into it. I'm going to share my screen and walk this through with you. All right, so this is literally the same rental real estate analysis that I use and be happy to share with you. I've borrowed it from other investors and mentors that I've worked with or that I work with and I've been guided by. And so just going to pass it on to you. It's pretty straightforward is, property value. These numbers are all real, by the way. This is a property that I bought in 2021. But we'll play with them just to see what happens. So I paid full price for this property. I couldn't get it at a discount, but say you get something at a discount and it's actually, worth, I don't know, 350, but you bought it for 330. Cool. That changes some of the math as you see these equations change, but for the most part, the main thing that matters is this number here, the purchase price. So for all intents and purposes, I'm going to put it back to that. So again, that's just a way to, show your equity at purchase, if you will. And then depending on your, down payment position, etc. So at the time, I got an awesome rate of 3.6%. I only put down 20% down. So if you hear that, you have to put 25% down on a rental loan. That's not always the case. I didn't have to pay any points to get that. But again, loans change all the time. So don't get hung up on that. I did this one, finance it over a 30-year period. So that's the loan amount, annual payment, monthly payment, that kind of thing. So down payment was 66,000. This one I got pretty lucky. I don't know if lucky, it was strategic. It was my decision to buy a property that didn't need much work. Okay, the AC was new, the water heater was new, the garage door opener was new. I just, again, let's say I got lucky. Just that was the house that made the most sense for me. So all it needed was some carpet in some of the small bedrooms and then new interior paint and just some cleaning. So I spent about $5,000 on it. I've got another property that I'm currently in the middle of that is pushing 25,000 to get ready. So, but different goals. I bought that one a lot deeper discount than this one. I paid, full price, if you will. So I had some closing costs. So the total cash required was that number to buy the property. So here's, if you really want to get nerdy on the financial performance, the cap rate, capitalization rate, cash on cash return, just spits out the equity in year 5, which is kind of a fun number to see. And then, so you're changing these blue fields if you haven't picked up on this yet. And then the next thing you'll change is the rental income, the expected rental income, right? And I can work with you on coming up with a number that feels right. And this doesn't have to be perfect today, just, a litmus test, or not today, but as you analyze, if that number is 1900 or 1850, whatever, as long as the cash flow, which we'll get to here in a second, has enough margin that you're comfortable with. So if the rent turns out to be 1900, cool, that's even better, or 1800, that's okay too. But if we're, say, at this number and it's already a negative 200, then it's like, oh, we got a problem. Okay. And then these 3 are your choice. So I'm going to leave them up to you. And maybe it's dumb or naive on my part, but I don't stock away extra for vacancy, because if this house goes vacant, I can cash flow that myself. I don't know. I don't have a pivot on that other safety or savings account, if you will. Same for maintenance. If something crashes out on it, I mean, I've spent money on this house. Water main had to change out a couple months ago, like 600 something bucks. I just paid it out of out of the fund. So anyhow, but and then management fee, that's again completely up to you. If you want to hire a professional property manager, typically they charge about 10%. Um, you know, as a rule of thumb, but every firm is different. I'm not a property manager. I'm not going to be, at least as of recording this video. I don't plan on be, but anyhow, so that I would key into that in case you're not going to do it yourself or you're out of state or something. Plug that number in as 10% there. But again, just because these are real numbers for my equation, I'm going to pull that back out. And then here's one you'll have to, I did some math to automatically calculate these kind of behind the scenes stuff. So those numbers will populate for property taxes and insurance. Again, they're not perfect, but they're pretty darn close. So again, they're super useful. If there's an HOA, which most Arizona properties have, plug in the HOA per month. Now, some HOAs charge per quarter or semi-annually. So break that down to a monthly fee because these are all monthly assumptions. And then if there's any miscellaneous expenses that you want to account for in here and attribute directly to this property each month, you can. Okay. As you see, I don't. I mean, I have a contract with a HVAC company that for $14 they put me top of the line if I ever need assistance, and they check the AC units twice a year. So it's a good peace of mind. If you're doing any lawn care, pool care at properties, plug those numbers in, as they will change your cash flow. And then this TPT tax, again, that's a transaction privilege tax. I do the calculations for you, at least in the city of Chandler. It's like 1.5% based on the rental income. You pay that annually though. So before you do that and set that up, make sure we talk so you don't make the same mistakes I did, because it's annoying to pay monthly. And I made that mistake in the beginning. And then these are some things that you don't really change, just some assumptions going forward that you'll increase the rent by 3%, or the property taxes will go up by 3%. Utilities will increase by 4% if you're paying them. If not, who cares? Let's see what else. The properties are going to appreciate at a 5% historic normal rate, and your closing costs, again, numbers here. So once you get these blue items plugged in, and again, you see that I didn't plug in every single one, but plug in the blue, and then you'll go to the next tab and it comes out with your cash flow. A lot of stuff here, year 1 all the way up to year 30. So your gross scheduled income for the year, this is all annualized, everything annualized. So let's just scroll on down to really what matters here in yellow. Year 1, your monthly cash flow at $395 in this particular situation. So as you can see, if I had a property manager in, how that would change things. It goes from $395 to $210. Okay, you plug stuff in, it changes, right? You've got volunteer to take care of the lawn, whatever it may be. Like that changes the number. You can negotiate all that type stuff. So anyhow, that gets to that number. And these are just, it does some math for you, principal pay down, what the renter's helping you pay down. So building that equity gap. This is your appreciation. So this is when I go back to my first video talking about ideal real estate, income deductions, equity appreciation and leverage. So this is building equity here because the renter's paying your loan down, and this is increasing the appreciation. It's going up by that 5%, the number that we plugged in. So your effective net cash flow is $24,000 in that first year, which is pretty awesome. And then here again, going back to that ideal depreciation, you can depreciate the property $9,000. Again, I'm not a CPA, so I'm not going to go super in depth into that, but essentially the physical structure of your home loses value, even though the intrinsic value goes up. So again, I'm not going to go into that on this video, but it's a great way to reduce your taxable income, and totally legal, totally normal, and definitely take advantage of that. If your CPA isn't doing that for you, then you need to fire your CPA. Mortgage interest, again, another tax benefit. So, you know, in year one, as you remember, we were in an equity position at 66 at purchase. And here, with all these factors, you are in an equity position of close to 85. So $20,000 increase, mainly through these two things right here, principal pay down, and then just this straight up appreciation. So then it goes further into the future. You know, you could, if rent stayed at well, not stayed, but it, you know, rent started at 1850 and we're projecting an increase of just 3% per year. You know, it'd go to 441, 489. And then, I mean, it's crazy to think that in, you know, year 30, you'd be renting this house out for almost $2,500, right? And I mean, it be paid off. You know, that's all straight up cash. Um, that's so this is why it goes back to my other video that talks about the rental retirement strategy and using these because you're spent essentially only paying 66 or $76,000 to acquire this property, and you're going to end up with a monthly cash flow in, you know, 30 years of 20, you know, 2,500 bucks, right? And then your equity, you know, your property value is, you know, $1.2 million. That's just hard to fathom. So you could sell it, live off that. I mean, just think about this. If, you know, if you had $2,500 coming in on just one property, how many properties do you need to retire? I know I get tomorrow's dollars are different than today's, but do you live off 10 grand a month? So what, 4 properties? Or, you know, fast forward 30 years, like maybe you need 8 of these things, but say you would, you know, acquire one property a year or one property every 3 years or one property every 5 years. So what? You could get in a position that you wake up 30 years from now, you're, you know, 30 years old, 35 years old. And when you're 60, 65, you know, 70, 75, whatever it may be, you've got cash flow of $10,000 a month by owning only 4 properties. So again, check out that other video about that retirement strategy. But bottom line is this is the rental real estate analysis calculator. Any detailed questions, please let me know. I love this topic and want to help you build wealth through real estate. Take care, guys.